There isn't one single dollar amount that triggers government reporting on your bank account. There are several, each attached to a different form, a different agency, and a different reason for existing. And a lot of online confusion comes from people mixing them up or hearing about one and assuming it applies more broadly than it actually does. This video walks through 5 specific verified thresholds: the one for large cash transactions, the one for interest your bank pays you, the one for money held overseas, the one with no fixed dollar amount at all, and the one that applies specifically to payment apps. By the end, you'll know exactly which of these actually apply to your own banking, and which ones don't. Number 1. $10,000. Large cash transactions. This is the threshold most people have heard of, even if the details are often garbled. Under the Bank Secrecy Act, a bank is required to file a currency transaction report for any cash deposit or withdrawal exceeding $10,000 in a single day per customer. Multiple smaller cash transactions at the same institution on the same day are added together against this threshold. This applies specifically to cash versus physical currency. It does not apply to a $10,000 check, a $10,000 wire transfer, or a $10,000 debit card purchase, all of which involve entirely different reporting mechanisms, if any at all. Filing this report is routine and doesn't by itself indicate any wrongdoing. It's a standard compliance requirement applied uniformly, regardless of the purpose behind the transaction. Number 2, $10. Interest your bank pays you. Here's a threshold most people don't even think of as government reporting, because it feels more like ordinary tax paperwork than a compliance rule. If your bank pays you $10 or more in interest during the year on a savings account, CD, or similar account, they're required to send you, and the IRS, a Form 1099-INT. The detail that catches people off guard. Even if you earn less than $10 and never receive that form, the interest is still fully taxable income, and you're still expected to report it on your return. The $10 threshold determines whether the bank has to send you paperwork. It doesn't determine whether the income itself counts. Number 3, $10,000. Money held overseas. Here's a threshold that surprises people specifically because it applies even if you never set foot outside the country and never intended to hide anything at all. If you're a U.S. citizen or resident with a financial interest in, or signature authority over, one or more foreign financial accounts, a bank account, brokerage account, or similar, and the combined value of all of those accounts exceeds $10,000 at any point during the year, even for a single day, you're generally required to file a report of foreign bank and financial accounts, commonly called an FBAR, using FinCEN Form 114. This is a completely separate filing from your regular tax return, submitted directly to the Treasury Department's Financial Crimes Enforcement Network, not the IRS, with its own deadline each year. And the threshold is genuinely aggregate. 3 separate foreign accounts holding $4,000 each add up to $12,000 combined, which crosses the threshold and requires filing, even though no single account individually reached $10,000 on its own. The penalties for failing to file when required are notably steep. A non-willful violation, meaning a genuine, reasonable mistake, can still result in a penalty up to roughly $16,500 as of this year. A willful violation carries penalties of the greater of roughly $165,000 or 50% of the account's balance, with potential criminal prosecution in more extreme cases. If you have any foreign account, even one you consider minor or largely forgotten, it's genuinely worth checking whether this requirement applies to you. Number 4, no fixed number at all. Suspicious activity. Here's the threshold that isn't really a threshold, and it's exactly the one that generates the most confusion online. Separate from the currency transaction report, banks are also required to file a suspicious activity report, or SAR, whenever they know, suspect, or have reason to suspect that a transaction involves funds from illegal activity, is designed to disguise the source of funds, or simply doesn't have a clear, apparent lawful purpose, regardless of the dollar amount involved. There's no fixed number written into this requirement the way there is for the currency or foreign account thresholds. It's based entirely on the bank's judgment about a transaction's overall pattern and context. This is also where a specific federal confidentiality rule applies. Under 31 U.S.C. Section 5318, it's illegal for a bank employee to tell you that a SAR was filed or even confirm that one exists. If you've ever experienced a vague, seemingly evasive explanation for unusual account activity, this confidentiality requirement is very often the actual reason behind it, not evasiveness on the part of the person you're speaking with. This is also the category most often confused with a lower dollar threshold. Banks do pay closer attention to transactions in the roughly $1,000 to $10,000 range specifically to detect structuring, deliberately breaking up a large transaction into smaller pieces to dodge the $10,000 currency reporting threshold, which is itself a separate federal crime under 31 U.S.C. Section 5324. This closer attention to that dollar range is real, but it isn't a new lowered reporting threshold. It's long-standing monitoring for a specific evasion pattern, not a rule that applies to ordinary transactions in that range. Number 5, $20,000 and 200 transactions, payment apps. Here's a threshold that changed relatively recently and caused real confusion in the process. If you receive payments for goods or services through a third-party platform like Venmo, PayPal, or Cash App, that platform is required to send you and the IRS a Form 1099-K once you cross both $20,000 in payments and more than 200 transactions in a calendar year. This specific combined threshold returned after a lower $600 threshold was proposed, caused significant public confusion, and was ultimately never fully implemented before being formally reversed. This only applies to payments specifically tagged as goods and services. Personal transfers between friends and family, like splitting a bill or paying someone back, were never covered by this requirement in the first place. A handful of individual states set their own lower thresholds for state-level reporting purposes, so this can vary somewhat depending on where you live. Putting this together for your own situation, here's how to think about which of these 5 actually applies to you. If you occasionally make a large cash withdrawal or deposit for a major purchase, a gift, a large expense, the $10,000 currency threshold is the one to know. If you have savings earning meaningful interest, the $10 threshold determines whether you'll receive a 1099-INT, though the income is taxable either way. If you have any account outside the United States, the $10,000 aggregate FBAR threshold deserves real attention, given the size of the potential penalties for missing it. The suspicious activity threshold has no fixed number and generally isn't something an ordinary transaction pattern would trigger. And if you're paid through a payment app for goods or services, the combined $20,000 and 200 transaction threshold is what actually governs your paperwork today, not the lower figure that was proposed and never took effect. 5 different numbers, 5 different purposes, and a genuine amount of online confusion mixing them together into vaguer, less accurate claims. Knowing which specific threshold actually applies to your own banking situation is the difference between reasonable awareness and unnecessary anxiety about a rule that may not even apply to you.